You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard, and welcome to the Limitless Wealth Method podcast. My effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. Every week, I'm pulling back the curtain on money, leadership, lifestyle, fitness, mindset, and emerging tech. Basically, anything that can help you perform at your highest level. So if you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch an episode on YouTube, and share it with just one person in your network who'd get something out of it. My goal is simple: help you grow your wealth and your life one episode at a time. So let's get into it. I've been getting the same question a lot lately. Jason, what do you think the next 5 to 10 years will look like? And how should I be positioning my wealth? And honestly, it's the right question to be asking because we're living through something that only happens once every 80 to 100 years. Today, I'm going to walk you through what's called the fourth turning. It's a historical cycle that explains why everything feels so unstable right now. And more importantly, what you can do to prepare. This isn't a prediction. It's a pattern. Economies reset. There are empires that wobble. And the world feels like it's breaking apart, only to rebuild itself in a new form. So if you've been wondering how to protect your wealth, how to position for what's next, or just how to make sense of all the chaos, this episode is for you. So let's dive in. What is a fourth turning? Well, the term comes from authors Neil Howe and William Strauss, who studied centuries of generational and social cycles. They noticed that history tends to move forward through 4 repeating seasons. The high, which is a period of rebuilding after a crisis. Think 1950s post-World War II America, where you have optimism and unity and growth. And then you have the awakening, where people push back against institutions. There are culture shifts. That was the 60s and 70s. And the unraveling. It's where institutions start to weaken. Trust fades in those institutions and polarization rises. That's the 80s through the early 2000s. And then you have the crisis or the fourth turning. Everything that's been building up finally breaks. The old systems collapse and the new ones are born. We've been in this current fourth turning since around 2008, starting with the Great Financial Crisis. The authors, Neil and William, predicted it would peak somewhere between 2025 and 2030, which lines up pretty well with where we are today. But of course, those numbers aren't a perfect science. They could extend beyond that. So let's break down what's going on in plain English. And we talked about some of these terms in the previous episode. So I'm going to rehash some of this stuff just to give you a better understanding of what it all means and how it all works itself into the fourth turning. The government is spending way more than it's taking in. So we have fiscal expansion. And every fourth turning, debt explodes because leaders throw money at crisis. So those crises could be wars, they could be pandemics, bailouts, social programs. And the result is more money is flooding the system than the country can actually absorb. And what does that mean for you? It means that excess money has to go somewhere. It drives up asset prices and drives up inflation. Your dollar buys less, but real assets like property and businesses and precious metals tend to hold value. The other thing that's going on is in a fourth turning is that you have financial repression, where the government keeps interest rates below inflation and they do it on purpose. Let's take an example. You earn 3% of your savings. Inflation runs at 5%. You just lost 2% in purchasing power. That's financial repression. It's how governments quietly shrink their debt by transferring wealth from savers to borrowers. And what does that mean for you? If you're still sitting in cash or bonds, you're the lender and you're losing. The government wins. Unfortunately, savers don't in this type of environment. The other thing that's going on is monetary debasement. This is just a fancy term for printing more money than the economy produces in goods and services to match. When that happens, each dollar buys less. We saw it with COVID stimulus, and it's still happening now. It's just happening slower. And what it means for you is that cash loses value over time. So holding too much of it is guaranteed loss in a fourth turning. And then you have negative real returns. Let's say your bond pays 4%, but inflation is running at 5%. So you made money on paper, but you lost purchasing power in reality. That's a negative real return. And during fourth turnings, this happens a lot because governments need cheap debt. So they let inflation run hotter than interest rates. So what does that mean for you? It means traditional safe investments like bonds and savings accounts aren't actually safe. They're quietly eroding your wealth. And then last, you have populism. And that's when politicians, left or right, promise to fix the system for you, where you have maybe they promise higher wages or more subsidies, more tax cuts, trade protection, debt forgiveness. Sounds great, but all of it adds up to more government spending, more debt, and more inflation. Both parties do it. Republicans cut taxes and boost defense, while Democrats expand social programs, and it's just different tools with the same result. So what does it mean for you? Expect more volatility, more policy whiplash, and more reasons to stay nimble with your portfolio. And to put some context on this, I wanted to show you a quick diagram so you don't think I'm lying in any way, shape, or form, which hopefully I can find. Of course, when I'm on this, tends to not. Here we go. Okay. So hopefully everybody can see this, but if you can't and you're listening on Spotify, I'm going to upload this to uh, the episode. And basically all this is it's showing you in the post-war era, Republican administrations and Democrat administrations, and when it comes to burdening the country with debt. And when you look through this, you're going to notice in no uncertain terms that both of them actually produce a lot of, really in tandem, they both produce about the same amount of debt. So it's just showing you, on a data-based chart on who spends what. Now, what happens in markets during fourth turnings? Historically, fourth turnings bring four things: higher inflation, where your costs go up; higher nominal growth, your paycheck or your revenues might rise, but so do prices; weaker real growth, so after inflation, your net gain is smaller; and then you have bigger market swings, so booms followed by sharp drops, which we've seen over the past 5 years pretty regularly. So let me translate that. Your portfolio might look great on paper. Stocks are up, revenues are up, wages are up, but inflation really cuts away at the real gains. So that's why traditional 60-40 portfolios, where you have 60% stocks, 40% bonds, tend to struggle during these periods because bonds get crushed by rising inflation or sticky high inflation, and stocks get hit by volatility and policy shocks. So what do? Right? That's the big question. You can't just buy and hold through a fourth turning and hope for the best with all these aggressive ups and downs. The range of possible outcomes, meaning the dispersion of possible outcomes, what could happen to the economy, to policy and markets, is wider than anything most investors alive today have ever seen. Because policy can flip overnight. Inflation can spike, then crash. Markets can melt up and then melt down faster than anyone expects. That's why the old playbook doesn't work anymore. That 60-40 playbook. You have to have a strategy that can shift with the environment, which we're going to kind of go through later. One that doesn't rely on everything going right, but is built to handle whatever comes next. Because in this particular environment, adaptability beats certainty any day of the week. So before we go any further, I want to acknowledge something. What we're about to talk about, geopolitical shifts, conflicts, structural resets, this is kind of heavy stuff. It's not easy to think about, and it's certainly not comfortable. But here's the thing. Understanding these cycles isn't about being pessimistic. It's about being prepared. And every fourth turning in history has been painful, but it's also been necessary. It's how old systems break down and new, stronger ones are built. The Revolutionary War gave us independence. The Civil War ended slavery and launched industrialization. And World War II made us a global superpower. This fourth turning, it's going to reshape the global order, it's going to rebalance power, and likely produce a better, more sustainable path forward for the US and the world. But to get there, we have to go through it. So I'm not sharing this to scare you. I'm sharing it so you can see the bigger picture, understand what's coming, and position yourself accordingly. Because the people who understand this cycle are the ones that come out stronger on the other side. All right, let's chat about geopolitical and social shifts happening right now. So every fourth turning comes with a global realignment, and this one's no different. Here's really what we're seeing. Trade is slowing down. So countries are pulling back and they're protecting their own industries. Globalization as we knew it is reversing. Supply chains are being redrawn and tariffs and trade wars are becoming the norm, not the exception. The big one is de-dollarization is underway. For decades, the US dollar has been the world's reserve currency, the foundation of global trade and finance. But that's shifting. We're seeing a declining share of US dollars in global reserves, trade invoicing, and foreign exchange settlement. Countries like China, Russia, and even some of our allies are actively working to reduce their dependence on the dollar. This isn't happening overnight, but it is happening. And if it accelerates, it could be one of the biggest geopolitical and economic shifts of our lifetime. A really interesting idea within fourth turnings is that birth rates tend to fall. Typically, fewer workers means slower long-term growth. Now, I'll use a disclaimer here and say AI may change that productivity dynamic, which is why so much money is being poured into that industry. But aging populations put pressure on social systems, and immigration becomes even more politically charged at that time. So it's not just a US problem, it's a global problem, and it's structural. And then you have wars and conflicts that are rising. Historically, every fourth turning ends in some form of major conflict or system level struggle, sometimes global, sometimes internal. We're already seeing it. We have proxy wars, we have cyber warfare, we have economic sanctions, we have rising tensions between major powers. Now, total war isn't inevitable, obviously, but based on history, it is a high probability outcome in this cycle. That's not fear mongering in no way. It's just a pattern recognition that there are growing pains of a new order being born. And then you have inequality will eventually peak and then reset. We are in a K-shaped economy where the top K is where all the higher income earners are, and the lower part of the K is where the lower income earners are. And that separation is becoming larger and larger. So income and wealth inequality have been rising for decades, but in every fourth turning, that trend reverses. Why? Because crisis force structural change and policy shift and power redistributes and the system resets. We're likely not quite at the peak of inequality right now. What comes next, whether through policy, inflation, or social upheaval, is a structural decline in that gap. And that doesn't mean everyone gets richer. It just means that the wealth distribution reshuffles. And those who understand the shift can position accordingly. Let's make this actionable. What can you do to prepare? Well, I'll give you a number of different ideas, and you can decide what kind of fits with your thoughts. You can own real assets. Many of you already do. These are things that hold and grow in value as money loses value, right? It's gold, it's silver, it's real estate, it's Bitcoin, or business ownership. When inflation runs hot or stays sticky high for a while, tangible assets tend to outperform paper promises. Also, number two, avoid being the lender, as we mentioned before. That means be careful holding long-term bonds or too much cash. When inflation is higher than interest, lenders lose, borrowers win. In other words, governments win, savers don't. You absolutely, number three, must diversify across regimes. So don't rely on one type of portfolio forever, this buy and hold strategy that you've had for the last 20 years, because the world changes and your portfolio needs to change with it. In a fourth turning, the range of possible outcomes, as I mentioned, gets way wider than anything most investors alive have ever seen. What happens? Well, when that happens, traditional buy and hold logic breaks down, as I mentioned. So 60-40 portfolio of public stocks and bonds that work great for the last 40 years isn't really built for this environment. So what does real diversification look like today? Well, there are three main components that provide some real diversification away from some of the public market volatility that we're seeing. One, private equity. Instead of just owning public companies through the stock market, you can consider allocating to private equity. You have direct ownership in businesses that aren't subject to daily market swings. Private equity gives you exposure to growth, but with less correlation to public market volatility. So you're investing in real businesses, real cash flow, and real value creation, not just ticker symbols reacting to headlines. Number two, there is private credit. In a world where bonds are getting crushed by inflation and interest rate volatility, private credit offers a real alternative. You're lending directly to businesses, often at higher rates than public bonds. And if you're getting paid for taking on that illiquidity, you're getting paid more. Private credit tends to be floating rate, which means as rates rise, so does your income. And it's secured by real assets or cash flows, not just a promise from a government or a corporation. It's a way to generate income without getting destroyed by rising rates. And then third, you have hedge funds and alternative strategies. Hedge funds get a bad rap. It's just a dirty word these days for some reason, but the good ones aren't just risky bets. They're designed to perform across different market environments. Long, short equity strategies, there's macro strategy, global macro strategies, there's managed futures. These are tools that can make money whether markets go up or down or sideways. The key is they're not just buy and hope, they're actively managed to adapt to changing conditions. So the real bottom line is true diversification today isn't just owning 20 different mutual funds or spreading your money across large cap, mid cap, and small cap stocks. It's about owning assets that behave differently when the world changes. Public markets, private equity, private credit, hedge funds, real assets like real estate and precious metals. Each one of those plays a role in how you protect and grow wealth in a disruptive cycle, like the fourth turning. Because in this kind of environment, adaptability, again, beats certainty. Another thing that you have to be aware of is that you have to stay liquid in a fourth turning and nimble. Fourth turnings bring shocks, and they bring many shocks. They bring new policies, new tax changes, wars, bank crisis. You have to keep flexible. So you avoid heavy leverage. You have to maintain cash for opportunity and think in months, not quarters, not years. And you also have to plan for higher taxes, even though it may not go in that direction, right? Right now, we don't have to worry about that. But when debt piles up, governments eventually raise revenue. And that usually is through capital gains, income, or wealth taxes. But there are some structures that can legally shield your gains. So why don't we talk about two if you're sitting on appreciated real estate or a big liquidity event. The first option that I want to talk about is a 1031 DST. Most people know about 1031 exchanges, where you sell a property, you reinvest the proceeds into another property, and you defer the capital gains tax. It's been around pretty much forever. But here's the problem. In a traditional 1031 exchange, it requires you to find a replacement property within 45 days of sale and close within 180 days. And you have to actively manage it. And that's where a Delaware statutory trust comes in, or in other words, a DST. A DST is a prepackaged, professionally managed real estate investment that qualifies for a 1031 exchange. So you sell your property and then you roll the proceeds into a DST and you're done. No tenants, no toilets, no headaches, right? You still defer the taxes just like you would in a 1031 exchange, but you now own a fractional interest in an institutional grade real estate. So think multifamily, medical offices, all bay, triple net distribution centers. And those are all managed by professionals that do it, large sponsors that have been doing this for years. It's passive income, it's tax deferral, and it's diversification all in one. And you can keep rolling these over as long as you want. So who's a 1031 DST for? It's really for real estate investors who want to simplify, diversify. Maybe they diversify geographically or in different sectors, or they step away from active management without triggering a massive tax bill. The next option is a qualified opportunity zone. Now, there are some new rules to this, and we're going to get into those because I think they're important. The new rules are really game changers, and it really just made QOZs, or qualified opportunity zones, one of the most powerful wealth building tools in the tax code. On the 4th of July this year, Congress passed what's been called the Opportunity Zone Fund Modernization Act, and it completely revamped the program. And here's really what you need to know about it. QOZs are specially designated areas, usually economic distress communities, where you can reinvest capital gains and get serious tax benefits. So let's say you sell an asset. It could be Bitcoin, it could be stock, it could be real estate, it could be a business or any other crypto asset. Instead of paying taxes on that gain right away, you roll it into a qualified opportunity fund within 100 days. That defers the tax, but it gets better. The program, the QOZ program that just went through on the 4th of July, is now permanent Before, there was a little uncertainty about whether the program would continue. Now it's locked in, and QOZs will be reevaluated and redesignated every 10 years. And the new version of the program kicks off January 1st of 27. So this isn't going away. You can build long-term strategies around it. And one of the things that is really important is that you get a rolling 5-year capital gains deferral. This is huge. So starting with investments made after December 31st of 2026, you get defer capital gains for 5 years from the date of your QOZ investment. So you don't have to scramble to meet the hard 2026 deadline from the previous iteration of the QOZs. It's a rolling deferral now, way more flexible. Basis step-ups are back. What do I mean by that? If you hold a QOZ investment for 5 years, you get a 10% step up on your deferred gains. That means you only pay tax on 90% of the original gain. Now, the new option within this QOZ program is if you invest in a rural opportunity zone fund and hold it for 5 years, you get a 30% step up. Now you're only taxed on 70% of the original gain. That's a massive incentive to invest in underserved rural communities. So rural OZ funds get special treatment, right? They now have easier improvement standards because they often lack infrastructure and they have more favorable tax treatment, like that 30% step up. And if you're willing to invest in rural project, the government just made it just really way more attractive. And last, you still get a 10-year tax-free growth, and you can sometimes potentially, in some instances, hold it for 30 years. Let me explain that better. This is really the crown jewel of the program. So let's say you invest in a QOZ and you hold that QOZ investment for 10 years. You pay zero tax on the growth. So if you had $1 million that you put into a QOZ investment, at the end of 10 years, it's worth $2.5 million. That $1.5 million in investment gains, you pay zero tax on that. It's not deferred, it's not reduced, it's eliminated. And here's the kicker. You can hold the investment for some of the options for up to 30 years and still get this benefit. So you can defer the old gain, reduce it with a step up, and eliminate the new gain entirely. It's one of the most powerful wealth building structures in the entire tax code. I don't know many that'll do that. So the bottom line is that this new law brings permanence, clarity, and even better tax benefits, especially for long-term investors willing to commit capital to meaningful projects. A lot of these projects do phenomenally well. I was involved in one in Virginia, and it did great. So even though it says you're in underserved communities, a lot of these sponsors do a bang up job on providing some really good opportunities in the QOZ space. So if you're sitting on a big capital gain and you're planning for higher taxes, which you should be, then QOZs give you a legal, powerful way to defer, reduce, and eliminate taxes while building wealth in high growth, undervalued areas. So really, when going back to the fourth turning, you really have to position your business and your career for change. Wealth just isn't about investments. It's also about income durability, right? So if you're a business owner or you're an executive, you got to look hard at where your income is tied to the old economy versus the emerging one. The fourth turning is reshaping entire industries. You have energy, manufacturing, AI, healthcare, logistics. The winners will be those who adapt their skills, their teams, and their businesses, their business models to serve where capital is flowing next. What I see a lot is investors' mindsets during a fourth turning completely change. You really have to position your mind for chaos and trust your wealth manager. I know that seems weird, but it is true. Because let's be honest, during periods like fourth turnings, emotional control becomes your greatest asset. You can have the best portfolio in the world, but if you panic, it won't matter. So focus on what you can control. You can control your process, your health, your relationships, and your perspective. I talk a lot about adaptability. That applies here too. Train yourself to respond, not react. Personally, I like to meditate. And when I build portfolios, I look at percentages, not dollars. Don't look at dollars. That's stupid. Look at percentages. It may seem simple, but it allows me to think unemotionally. You have to learn to stay calm when markets and media are screaming, because most of the money made in these cycles is made by the people who don't lose their minds when everyone else does. I'll give you an example, and I'm going to go on a rant here. Part of the reason why I tend to stay calm in crazy environments is when I started out in this industry and when I was 22 years old, and some people know this story, I started out in the pits of the Chicago Board of Trade, specifically the Dow Jones Futures pit. And that pit was filled with 300 guys that would soon enough knock you out and take your money than anything else. You had to learn to stand up for yourself. You had to have the courage to make the trades, believe in what your process tells you, and do it in an environment that was extremely difficult to think logically when everybody is yelling and it seems like it's chaotic, right? You have to find a happy place to really just make sure that you are calm, collected, and can make the proper decisions. Now, not everyone has that experience in their background, but there's a lot of things that you can do to manage your mind for chaos, right? And I think it's going to be one of your biggest benefits as we go through this time. And here's the thing, a big part of removing that emotion is trusting and leveraging your wealth manager. Your wealth manager is there to make sure you don't panic, right? That's a huge part of their value. When you hire a wealth manager, your trust in them is going to be paramount to your success going forward. If you're calling your wealth manager constantly during periods of volatility, checking in every time the market drops 2%, asking if you should sell, second guessing the strategy, that's a red flag. It means either a lack of trust between you and your wealth manager or a breakdown in communication, one or the other. Now, don't get me wrong. Communication is paramount to a good relationship. You should understand the plan. You should feel informed. But there's a difference between healthy communication and emotional panic disguised as engagement. If you find yourself constantly needing reassurance, ask yourself, do I trust this person? Do I understand the strategy? Do I believe in the process? Because if the answer is no, you're in the wrong relationship. But if the answer is yes, then let them do their job, because your wealth manager's role during volatile times is to keep you disciplined, keep you focused. So remember, the goal isn't to predict the next storm. It's to make sure your ship can handle it. Every fourth turning ends with a new beginning, but to reach it, you have to stay calm, you have to stay liquid, you have to stay focused. This is your chance not to not just protect your wealth, but to own your future. And if you ever want to talk through any of this and how it applies to your situation, no pressure, no pitch, you know where to find me. Just reach out. And thanks for listening. Again, I appreciate it. I am Jason Hilliard. And next time, we're going to take a right-hand turn into the fitness world. I am going to be bringing on a lovely woman by the name of Jennifer Hilliard, and we're going to talk about fitness, health, and everything in between, because as we get older and as we age, everybody wants to look a little bit better and get a little healthier. So I hope everybody got a little bit out of today. Obviously, if you have any questions, please don't hesitate to reach out. And again, we'll see you next time.